Welcome to Hidden Finance, the channel where economics and finance reveal their most hidden secrets. Today we'll uncover a new mystery that has shaped global markets and influenced the economy. Imagine a world where a single financial instrument holds the reins of global finance, guiding the decisions of Wall Street giants and subtly influencing the lives of people everywhere. This instrument may seem complex and distant, but its impact is profound and far-reaching. Today we're diving into this fascinating world to explore derivatives, the often misunderstood tools that play a pivotal role in shaping the global economy. When you hear the term derivatives, your reaction might fall into one of two categories. Either you find yourself yawning with boredom, or you immediately think it's too complicated and best avoided. But here's the truth. Derivatives are not only essential to understanding the movements of global finance, but they also offer a window into the sophisticated strategies used by the financial elite. In this video, we'll demystify derivatives, explaining what they are, how they work, and why they are so crucial. Let's start with a key point. Derivatives are far from a modern invention. In fact, one of the earliest examples dates back to ancient Greece, specifically to the story of Thales of Miletus as recounted by Aristotle. Thales, a philosopher who was often mocked for his lack of attention to practical matters, devised a strategy that would impress even the most seasoned financial strategists today. Thales predicted an abundant olive harvest, and months in advance, secured the exclusive rights to use all the olive presses in his town of Miletus. When the harvest turned out to be as bountiful as he had foreseen, Thales was able to rent out the presses at a significant profit. This ancient example illustrates one of the first uses of a contract, similar to what we now refer to as a forward, a type of derivative. As history progressed, the use of derivatives evolved, especially during the Industrial Revolution. A particularly notable development occurred in Liverpool, England, in 1821. At that time, Liverpool was a booming industrial city with a thriving cotton trade, largely dependent on imports from the United States. However, the lengthy journey of cotton across the Atlantic posed a significant risk. By the time the cotton arrived, market conditions could have changed drastically, affecting prices and potentially leading to losses for buyers and sellers alike. To mitigate this risk, traders began to create contracts that locked in the price of cotton for future delivery, regardless of market fluctuations in the meantime. This practice gave birth to what we now call the futures market. The futures market in Liverpool quickly became an integral part of the cotton trade, and by the end of the 19th century, it was so dominant that traders who did not use futures contracts were effectively pushed out of the market. This early example of a standardized futures market laid the groundwork for the modern derivatives market, which has since expanded to include a wide variety of assets and financial instruments. Today, derivatives are used in numerous ways, primarily for two purposes: hedging and speculation. Hedging involves using derivatives to protect against potential losses due to price fluctuations in an underlying asset. For example, a company that relies on oil for its operations might use derivatives to lock in a future price for oil, thereby protecting itself from the risk of price increases. On the other hand, speculation involves using derivatives to profit from anticipated changes in the price of an asset. Investors who speculate with derivatives do not necessarily own the underlying asset. Instead, they make predictions about how its price will change and structure their investments accordingly. One of the most common types of derivatives used for speculation is the option. Options give the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a certain period. The derivatives market is vast and complex, with a significant portion of it taking place in unregulated markets known as OTC, over-the-counter markets. Unlike regulated exchanges, where contracts are standardized and subject to strict rules, OTC markets allow for greater customization of contracts. This flexibility is both a strength and a weakness, while it enables parties to tailor contracts to their specific needs. It also means that there are fewer protections in place for investors. To access these markets, a specialized intermediary, known as a broker, is usually required. It's important to note that derivatives are complex financial instruments that carry a high risk of loss, particularly in the less regulated OTC markets. Globally, the derivatives market has grown to staggering proportions. As of the first half of 2023, the notional value of OTC derivatives meaning the total value of the underlying assets to which these contracts are linked, was estimated to be around $715 trillion. To put this in perspective, this figure is more than 6 times the world's total GDP. Such numbers highlight the sheer scale of the derivatives market and its critical importance to the global financial system. But how do derivatives affect the average person? While derivatives may seem far removed from everyday life, they play a crucial role in the financial decisions made by major institutions, which, in turn, impact the broader economy. For instance, derivatives are used by banks, insurance companies, and other financial institutions to manage risk and ensure stability in their operations. This stability is essential for maintaining confidence in the financial system, which affects everything from the interest rates on mortgages to the availability of credit for businesses and consumers. In conclusion, derivatives are complex but incredibly powerful financial instruments that play a fundamental role in the global economy. Whether used for hedging or speculation, these tools allow investors to manage risk and take advantage of opportunities in the market. However, their complexity and the high level of risk involved mean that they are not suitable for everyone. If you're considering investing in derivatives, it's crucial to educate yourself thoroughly, understand the potential risks and rewards, and make informed decisions. On our channel, we will continue to explore these and other financial topics to help you navigate the world of finance with greater knowledge and confidence. If you enjoyed the video, leave a like and subscribe so you don't miss the next mysteries of the economic world. But what's your opinion? Share it in the comments.